Good evening, everyone. This is Henry Gambell with SimplerOptions.com, and in tonight's free video, I wanted to follow up on some of the trade ideas that I had shared yesterday and just follow through the execution and the thought process around them, and then see if we can find another example to take into tomorrow. So one of the first ones that we looked at was lows, and the decisions that you have to make when you're managing trades like this is basically to come back and say, do I think that the underlying will be at a point where I still have any value from the intrinsic value of one of my options that's in the money? What that all basically means is that when I was looking at this and saying, okay, we wanted to put the strategy on in a way where we had no downside risk. So to start off with, that's a good beginning. When the stock was down as hard as it was today and continued to fall, I was looking at it and saying, okay, we initiated this for a 60-cent credit. At the time, it was trading somewhere near a 40-cent credit, so that leaves you with a $1 profit on the entire position. Is that a better way to close it out, or is it better to just leave it to expire? Well, if you leave it to expire and the entire thing just rolls over, then it's more advantageous to close it out while the 72 call still has some intrinsic value. As it started to trade back down below this level, that was not looking as intriguing to me, so I closed out the entire trade and we're done with it. Of course, if we were to fast forward in time and say, for example, that Lowe's closes exactly at 73 on Friday's close, well, then it would have been better for me to go ahead and hold the position because I'm going to have the 60 cents that I initially took in plus $1, exactly how far the 72 call is in the money, and that would have given me closer to about $1.60 of profit. So of course none of us know exactly where the stock is going to go, but these are the types of questions you can ask yourself to evaluate the setup. Then when we come in and take a look at CRM, this was exactly the same situation, because if you're looking at this thinking that the stock is just going to continue to head higher, then you'll be in a beneficial spot to go ahead and close it out because you're taking the initial credit plus the credit on the exit, and it makes for a pretty solid trade. As we were trading up and above that skyline today, I was giving it more of that thought that it could continue to push higher. Granted, it had made an extension, but it was just looking to something to say, I'm going to take the money and be done with that one. If it did continue to push higher, of course it's still very easy to manage. Now, that's the long or a bullish and a bearish perspective on that particular strategy. VMware is due up tomorrow, and as I look at this, it's really a tricky one, to be completely honest with you, so I will probably look at trading it with pretty small size. You have some high short interest in VMware, which is intriguing, but you're also so close to that extension. You've had such a good run into this report that I think it's a little bit of a tricky place to say that I just want to be outright long. That's not really the way that I'm going to look at it. And if anything, I think you might structure a little bit of a butterfly back to the downside. Now granted, this is a bullish chart, and if you want to play it in a bullish way, I can completely respect that. But as you think about various ways to structure your butterfly, this would just be where I would look for more of a standard butterfly. I would start with the 97 body, because that would come back down roughly to the 8-day exponential. It would also leave you right to where you filled your gap. So that's how I get the body strike and the way that I'm thinking about it. And then I like to take these and I'll start off by placing them $3 wide and see if I can pay less than 1/3 the width of the strikes. So on something like this, you would need to see that VMware can move lower. If they have a great report and the shorts have to keep covering, well then you'll be out the 60 cents on that spread, but you're risking 50, 60 cents to try and make $2.50. And that's just one more way. Now that's a standard basic butterfly, so we do have a risk in both directions, but that's the way that I would structure this trade for a play back down into 97 to try to limit risk while maximizing rewards, and that will be where I'm focusing tomorrow. So I hope that is helpful. I also wanted to make sure that you are aware that John will be doing a free webinar on Thursday, August 24th at 7 p.m. Central. He'll be going over his 10x indicator that he's been using for some of his bigger swing trades and how he uses that to identify good momentum and really places where stocks will have good staying power to get you good continuation moves. So I'm looking forward to the review of this. If it's something you're interested in, it is completely free, and I hope to see you there tomorrow afternoon.